Hello everyone. Today we will talk about accounting ratios. It is very important for class 12, those who are in class 12 CBSE accounting. It is very beneficial for them. So please be with me till the end of the video, and if you are new to the channel, please subscribe my channel for more informational videos. This will help you a lot. Please be with me. So here we can see that accounting ratios, it starts from where? That it starts what basically is ratios. We need to understand. I will share with you some concepts first, then we will do the questions. So if you follow the concepts properly, you memorize the concepts properly, then easily you can do the questions. And it is very important because in annual exams, with reference to this chapter, your questions are coming. So please be prepared for that. First of all, we see what is ratios. Ratios is relationship between two figures in arithmetic terms. Then how can we express ratios? Ratios can be expressed in proportion or pure ratios. Okay. For example, 3:1, 2:1, it can be expressed like this. Then we can also express the ratios in rate or time. Then we can express the ratios in percentage, and then we can express the ratios in fractional. For example, 1/2 or 1/4, etc. This is how you can express your ratios into different categories. Dear students, next important thing in accounting ratios is that what is the analysis of ratios. Analysis of ratios is in two parts. One is cross-sectional and one is time series. In cross-sectional, how we analyze our ratios, that is when we compare our data with another firm in the same industry, that is called cross-sectional. That you are comparing your industry with another industry in the same category. Okay. So then time series is when you are comparing your past data with your old data. You are comparing your two data. For example, you are comparing the data of 2013 from 2012. So this is how when you compare our past data with our old data. This is called on the basis of time series. Analysis on the basis of cross-sectional and analysis on the basis of time series, both are given. Again, I will repeat, cross-sectional is when you compare your data with another firm in the same industry, and when you compare your old data, past data with your old data, so it is within your organization. That is called time series analysis. Okay, these are two main analysis of accounting ratios. These must be understood by you, and you have to memorize these concepts properly. Dear students, next part is benchmark. Benchmark is basically the criteria you have to set to check the ratios. Of course, you will set a criteria whenever you are doing the questions or you are making any amendment or development in your organization. You will set the criteria at which criteria you will see that what is the performance of our firm or the industry. So for that, you will make a benchmark. We will also call it a criteria. First benchmark is past ratios. Past ratios is on the basis of previous data, we will examine the ratio is good or bad. So if we are making past ratios, we will see that what is the performance of our organization in this year, and we will compare that with the previous ratios. Then we will see ratio of similar firm in the same industry. We will compare our firm within the same industry, like Coca-Cola. They have to, for example, we have Pepsi. So we will compare our organization with Coca-Cola because that is in the same industry. So on the basis of same industry or average ratio, we will see on the basis of performance, or we will make the comparison on the basis of performance. That is called ratio of similar firms. Rule of thumb is that you have to set a criteria. You have to set the ideal criteria that this is the minimum. For example, you say you start a business, you say that 1 million is the minimum profit I have to earn every year. So 1 million which you will set is your rule of thumb. Normally, like for example, current ratio, we call ideal current ratio is 2:1. So that if you have to current ratio of 2:1, you will consider that your business performance is ideal. So dear students, next part is what are the types of accounting ratios. There are four types of accounting ratios. Number one is liquidity ratios, solvency ratios, turnover ratios, and profitability ratios. So what is the function of all these ratios? Liquidity ratios is to check the short-term performance of the company. Okay. Solvency ratio is to check the long-term performance of the company. Turnover ratio is to check the working of the company, like company is working, how much sales company is making, how many debtors are there, how many creditors are there. To check all these kind of workings, we use turnover ratios. Profitability ratios are basically to check the performance of the profits, how much gross profit you are making, how much net profit you are making, how you are treating the retained profits. So all the things related to the profits you are checking in profitability ratios. So till now you have got the entire concept of ratios, okay, accounting ratios. First of all, what is their function, okay. After that, you have I have discussed with you about their analysis. Then we have talked about their benchmarking, their criteria, and after that we have studied the types of accounting ratios. You have to make sure that all of these concepts are on your fingertips. After that, you are able to do all the questions. If your concepts are not clear, it is going to you can say it is going to confuse you a lot. So be prepared before you go to the questions. All right. After learning the types of accounting ratios, dear students, we will start from the first accounting ratio, that is liquidity ratios. Liquidity ratio is, as we know, that it is a short-term ratio, and in this we have further two types of ratios. One is current ratio and the other is quick ratio. In current ratio, we can also call current ratio as working capital ratio, and quick ratio can also be called liquid ratio or asset test ratio. First of all, we will see what is current ratio. Current ratio equals to current assets over current liabilities. This is the formula for current ratios, and ideal current ratio is 2:1. Here we can see there are some important points while you are doing current ratios. You have to memorize these 3 points importantly. First of all, that you should exclude from current ratios loose tools, stores, and spares. These are the three main things you have to exclude from current ratios. And then provision of doubtful debt will not be recorded in current ratios. So this is the entire picture of liquidity ratios. In liquidity ratios, the first part, that is current ratio. In second part, we will come to know about the quick ratio. As we know, dear students, that in liquidity ratios, current ratios and quick ratios are there. We discussed before current ratios. Now we will discuss quick ratios. The formula for quick ratio is quick assets over current liabilities. So for this, we must know that what are the quick assets. Quick assets equals to current assets minus IPA. I is your inventory, P is your prepaid expenses, and A is your advance tax. So out of your current assets, whatever the thing is given in the question from IPA, inventory, prepaid expenses, or advance taxes, you have to minus that. From current assets, you will get your quick assets. Quick assets are also called quick assets are also called liquid assets. And then the ideal quick ratio is equal to 1:1. As we have studied, the current ratio, ideal current ratio is 2:1, and ideal quick ratio is 1:1. Till here, you have to keep all these concepts in your mind that is related to liquidity ratios. Okay, after that we will discuss solvency ratios. Okay, so entire concept from beginning till here, it should be on your fingers. Okay, after that we will start the questions related to liquidity ratios. Thank you.